Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I'm excited to have him back on, especially with this recent volatility in oil prices. He's energy expert and trend forecaster and also author of the Crash Course, and he's put out the most recent Crash Course videos, Chris Martenson of peakprosperity.com. Thank you for joining us again, Chris Martenson.
Hey, it's a real pleasure to be back. How are you doing today?
I'm doing pretty good, except for some of my oil investments here, which we were just talking about this before we started recording. I mean, this is unprecedented volatility in the oil price really since 2009, especially given some of the supply and demand fundamentals that we talked about before this. Chris, do you think that a strong dollar and a lower oil price, do you think this is the Black Swan that maybe some experts have been predicting would come out of nowhere and potentially crash everything?
Well, we know that we have a system that's poised with a lot of potential energy stored in it. You know, the trillions have been pumped, equity markets have been inflated vastly, the bond market's even more inflated. And so when you have big bubbles like that, you know as well as I do that's bubbles are always just in search of a pin. Could this be the pin? It could be because, you know, there's a few $100 billion worth of junk debt that's been issued. That a big chunk of that is actually issued into the U.S. shale operators. These are a variety of companies, small ones, large ones, this, that. So we know that they're hurting at this point in time. There's a lot of spin coming out of Wall Street saying, oh, no, these shale plays, they're profitable at 50 a barrel, 60. They're just making numbers up. And the truth is, portions of those plays are profitable at this level. Other portions aren't. There are companies that are playing in the fringes of these shale plays. Those are the ones that typically have the junk debt. They're getting hurt right now, and there are going to be defaults. Yes, this thing called defaults, which we have not seen in 5 years of money printing and excess liquidity, but unless the Fed wants to step in and buy that junk debt, we're going to see it. It's going to happen, no question.
Yeah, your video on the shale oil boom, I thought it was very insightful, talking about free cash flow. You know, something that most energy analysts don't talk about. Most energy analysts don't talk about the actual financials of the oil company. I mean, they may talk about supply and demand or things like that, but you included that in there. And, you know, even when the oil price was much higher, a lot of these shale oil companies were not generating free cash flow. They had to put a lot of their cash flow back in the ground for maintenance capex. It wasn't the free cash flow there where they had humongous dividends and share buybacks and things like that were, you know, capital efficient businesses. So it's just very interesting. You know, you talked about the Wall Street spin here, but also the thing about the strong dollar, and I haven't heard that many experts talk about this, is, you know, the developing currencies, the Russian ruble, which has, you know, gotten just absolutely hammered with this lower oil price. Some of these other developing world countries, they owe a lot of debt in U.S. dollars because they've had defaults in the past. So they've had to issue in the bond market, they've had to issue their debt in U.S. dollars. So while their currency has been falling, the dollar has been strengthening, and that's just onerous to countries like India and stuff like that. So that could be potentially either defaults or something like that, where, you know, the developing world becomes the subprime, and then you have the oil derivatives and stuff, which the oil bond market, which looks like it's been leveraged up with derivatives too.
Absolutely. You know, the strengthening dollar is, I believe, is happening for what we call math reasons, not for fundamental reasons. It's not that people around the world looked at the United States and says, wow, that's such a better place. I want dollars. What's happened is what you've mentioned. There's a lot of carry trades, and also there are a lot of foreign investments denominated in dollars. And so what happens is, you know, like with India, somebody in, you know, a hedge fund in the United States says, hey, I want to borrow money in the United States for 1%. I'm going to lend it to the Indian government, if you will, buying sovereign debt over there at, say, 7%. I got a 6% carry on the whole thing. Boom, I'm good, right? But when they unwind that trade, they have to sell those bonds in India. They have to sell the rupee. Then they have to buy dollars. And so you're seeing the rupee go down. You're seeing dollars go up for no other reason than that there's a speculative trade on the books that has to get unwound. It says nothing about how we feel about India or the United States, respectively. It's just something that happens. So this strengthening dollar is actually potentially another one of those pins. A strengthening dollar to me is not a good thing to see at this stage of the story for a lot of reasons, but it's because of the amount of the speculative carry trade that exists in the world. We could see that unwinding. So I'm not a huge fan of the constellation of things we see at this point in time.
Yeah, I agree about the carry trades. I was talking with another hedge fund manager friend of mine, Dave Scarica. I don't know if you're familiar with his work, but he was basically telling me that the hedge fund traders are trying to do carry trade with almost every single currency that they think is going to be devalued. They're trying to, do interest rate arbitrage and all these other crazy trades to squeeze out millions of dollars in fast money. And then when these things get unwound because there's so much leverage in the trade, these things could potentially blow up. And I think, they're viewing the dollar as a temporary safe haven. It's kind of like 1929, Chris. I know you've looked at financial history. During 1929, I mean, the rest of the world, whether it was Britain or the rest of Europe, it was all starting to collapse and in a major depression. And money was just flowing to the U.S., not necessarily because the U.S. was doing that much better than everyone else, although the U.S. then was actually manufacturing a lot of goods and services and things like that. The U.S. had a lot of innovation. It was running humongous trade surpluses, but compared to the rest of the world, the U.S. was so much better, but so much extra flight capital flew into the U.S. back then, and it went into the asset markets too. There was property bubbles back then in the Florida condos and swampland and things like that they turned into the periphery, into houses and things like that. And there was a property bubble, and I think we're starting to see that again too, where the developing world. People are very scared of investing in the developing world, whether that's China or India or Brazil or Russia, especially if you're from the U.S. or Europe. And that money's coming back to the U.S. for no other reason that I guess there's private property laws for now in the U.S. where they can put money, into U.S. real estate or the U.S. bond market or general U.S. stocks.
Absolutely. There's been capital flights all over the world because the whole world is awash in liquidity. This isn't a U.S. story. It's not a Europe story. It's not a Russian story. It's not Chinese. The whole world has been inflated massively. And so we've never seen anything like this before. Now what's clearly happened when you inflate asset markets is you take a very, very tiny portion of the population, you make them fabulously rich. That's happened in every continent I've just mentioned and country I've mentioned. So we're seeing enormous quantities of wealth. And if I was somebody who had $100 million, $1 billion, and I wanted to be as safe as I could, you bet I'd be engaging in massive amounts of capital flight. I'd be stashing that everywhere and anywhere I could. I'd be looking for the places with the best possible protection laws. I'd be looking for places where I would think I might have a decent chance of getting asylum with my family or a second passport. These are all things that we're seeing happening all over the place, whether it's real estate in Vancouver from Chinese nationals buying that up because it's the shortest, quickest flight over and they like Canada, or we're seeing the same thing in the Bay Area in California. We're seeing it in a lot of the trophy markets, and it's not just Chinese, but we're seeing the same with Russians and everybody. So yeah, that's part of this story, and it's just massive global liquidity flows. But the rich people buying properties is just sort of an interesting side story. The one you mentioned where you've got mostly we live in a speculative world at this point in time, and we're seeing massive flows of capital based on things that just don't make sense to you or I, but for somebody who codes things and looks at relationships and is looking for arbitrage opportunities, hey, they make sense. You want to see one of the tightest correlations in the data series out there right now? Look at gold. Look at how much it's gone down in price. You'll read a million headlines explaining why investors this or Chinese demand that. But I want you to take that and then compare that to the Japanese yen, and it's got the tightest correlation of any data series I'm looking at right now.
Yeah, and that's basically just a computer trade, right? That the trend traders, these high-frequency trading algorithms, have decided that strong dollar, short yen, short gold, right? So that's basically been the trade that has worked for most of 2014. And, what we could argue all day, like you said, saying, well, look, the Chinese are buying 100% of the annual mining supply globally all by themselves. And I could show you Kuz Jensen's numbers, how with the Shanghai Gold Exchange and things like that, how much extra metal India is now buying and how the rules have changed in India. It looks like the import duties are lower. So we could talk about the fundamentals like that, but these computers in the short term, and I talk with Eric Sprott and Jen Embry about this, and they admit this is one of the reasons why, they've been wrong trying to call the gold and silver price. These computer programs have just been in control in the short term of the paper market.
Yeah, and the computers, they don't care. They just don't care. They're trend followers, they're momentum followers, they're pair trade followers. They're following all sorts of clever little algorithms and rules that they follow, but fundamentals is not one of the rules that they follow for some reason. And so you could easily see, like a company, I've seen this, where companies report absolutely miserable results and the stock price shoots up, and you're just going, what is this all about? Is this just another short squeeze? But it doesn't really matter anymore. This is why it's frustrating for somebody like myself who considers himself a fundamental analyst to say, when does reality come back into this story? And I've been analyzing the oil market for a long time, and I will tell you that the amount of what we're seeing in the shale business is just a pyramid scheme, pure and simple, where we're seeing companies rolling over short-term junk debt, rolling it into their operations, and they're spending $1.50, some of these companies, of capital for every dollar of revenue they're generating. And they've been doing that for years. And you know these shale wells play out in 3 years, roughly 85, 90% gone. So if you're 5 years into a treadmill story and you're still burning $1.50 for every dollar you're earning, I mean, didn't we learn this lesson from Pets.com back in 1999? Didn't we learn this from subprime housing in 2007? The answer is no, we haven't learned it.
Well, Pets.com didn't even have any revenue, so at least these shale companies have some revenue. But I get your point there, though, that the financials are questionable for many of the higher shale oil producers. But I know people in Texas. We discussed about this in emails, and what they tell me is that, okay, yes, we are borrowing, we're not generating free cash flow, but we are paying the capital back, or at least when the oil prices were higher, they were paying the capital back fairly quickly. So it wasn't generating, enormous amounts of free cash flow, but the capital was being paid back when the oil prices were higher with the drilling at, in less than 2 years. So, but that's no longer the case now at this much low of an oil price. So now I think the economics are in serious question. Whereas before, when the oil price was around 100, I think the shale oil could make some money. But I think at these prices, it just doesn't make sense. But this is the problem when everyone's getting cheap debt with the subprime autos and things like that. So it's just very interesting. We're going to see what happened, how long maybe there's the Saudis or whatever else is going on in the oil market. I mean, we could speculate if it's just the Saudis or if it's the U.S. government and Wall Street helping out the Saudis with the paper oil market to knock the oil price down. We were talking about, before we started recording, how tight the oil market is on a supply-demand perspective. I don't think the Saudis have that much spare capacity at this point. I think the real marginal producer in the oil market right now, and you can comment on this, you're more of an energy expert than I am, the marginal producer has been the shale oil producer, right? Because since 2006, the only real global oil production growth on the entire globe has been from shale oil, really. They've had, I think, 85% of all the global oil production growth. So the rest of the world, despite how much CapEx they're spending, and I think we're spending, over $600 billion a year trying to find more oil and replace the oil production and reserves. Your crash course videos were excellent at talking about this. Maybe you can add to my points there or tell me where I'm wrong.
Well, there's to your comment around marginal producer, I'll add the largest marginal source of oil has been demand destruction in the OECD countries plus the U.S. At the center of that. So for as many millions of barrels that have been added by shale, even more have been reduced or deducted from total demand. And particularly if you look at what demand growth, where that would have been if we'd been growing demand as we had in the past, that's the largest gap. Now, when we cast forward, it's absolutely true that as the United States produces more, it tends to import less. And so that's been a big driver of global supplies, and that's absolutely true. The world, however, has spent, by my numbers, around $2.5 trillion since 2005 to get more oil out of the ground. This is all upstream spending. This is just data from Stephen Koppitz at Westwood. And so $2.5 trillion, and we're basically within still around a 5% band of production, because as fast as the United States is increasing its oil production, the rest of the world is actually declining a little bit. And the whole thing sort of balances out to a very, very slight increase in oil across the world. So, for all this talk about, the world's awash in oil and, there's just too much supply at this point in time, the truth is the world is out of any new cheap marginal oil. If we want more oil, we're going to have to pay more for it, a lot more by historical measures. So that's the world we're in. And so what I'm wondering, Jason, if what didn't happen here is that the world found out it couldn't really afford oil at $100, $110 a barrel. The world is now, as far as I'm concerned, pretty well in contraction at this stage when we look across the recessionary landscape. And now oil's plunging down, and we're going to discover that new oil production can't afford this price. And so do you get this sense with me that the cost of oil is a floor that's rising, but the amount of the price that the world can afford for oil, given all the debt that we're awash in, courtesy of the central banks. Thanks for all the new debt since 2008, guys. That's awesome. But that debt takes debt service. It becomes more debt you have, the harder it is to afford expensive energy. That's the ceiling on this thing. I get the sense we got a falling ceiling of what we can afford and a rising price for what it's going to cost to get out. That's the squeeze box I think we're in. And I think where we are right now with these low oil prices is just one of the first contractions of that accordion, if you will.
Yeah, I co-authored an oil report with my business partners, Mo Dawood and John Manfred, about the oil market in 2012. And what I thought was the oil market for the next, 5 years would be in a pretty wide trading range with some volatility, where the oil price would go up to maybe 125, 130 Brent at the high end of the range, and then the market and the world economy, the real economy, would have said, you know what, we can't afford this oil price anymore. The oil price would drop back down to about $80 a barrel then at the bottom of the range, and we'd pretty much just bounce around in that range for a while. So, when oil went up that high, it would be smart as an investor or speculator, it would be smart to maybe hedge your oil stocks or sell them. And then when oil dropped down to like 75 or 80, it would be smart to buy them because, we're in an environment where the companies, there's just no incentive, especially at the oil price we're in right now, to drill for a lot more oil. So, in order to bring on the oil supply, I think you brought up the production costs. No, you didn't bring up the production costs. You brought up the capex. But, the production costs, even for the Saudis, the production costs have risen at least 6% per year for over a decade. And if you're looking at the production costs for a lot of other current legacy fields, I think the production costs have risen 8% per year on average. So that's enormous doubling. That means the cost is doubling every 9 years for the rule of 72. So for our listeners out there who aren't familiar with compounding, and that's another thing about the crash course I think you talk about there is compounding, which the average person doesn't understand about how investing works. So they see, a 2% inflation rate. They see, the oil production costs or mining production costs are rising X number per year. They don't understand what this means in the long run, that 5, 7, 10 years from now, those costs are going to double.
Yeah, it's a great point. And in mining in particular, and I'll lump drilling and oil production in with mining, the costs there have been going up very close to 10% per year for a long time, almost a decade now. So as you mentioned, if you're going up at 10% per year, the rule of 72 says, well, at about every 7 years, your input costs are going to double. And that's just extraordinary. So, right now I'm looking at oil. I'm watching a chart right now. It's at 67.60 on the WTIC. That's a pretty low price. 10 years ago we would have said, oh my God, how could we survive that? That's too high. But now it's low, and I'm convinced that, oil, I don't know what it's going to do next week, next month. It could go down even further. But I'm pretty confident that if you're a patient investor, that oil has to go higher from here, because I know in my heart of hearts that price I'm looking at right there is not sufficient to drive new supply. It's way out of the band for deep water. Forget ultra deep water. It's not good for the heavy sands, tar sands, Orinoco Belt stuff down in Venezuela. And I don't think it works for most of the shale plays that exist out there. The cores, the sweet spots, the heart of it, fine. But for the rest of it, forget about it. And so, we're seeing all of the world oil majors really pull back on their capital expenditures. If you want to see that in real time, just pull up a chart of Seadrill. And take a look at how that company's doing. And so we're seeing this massive scaling back of activity. By the way, the biggest news this morning was they just reported that the drill permits fell 40% in November already.
For shale or for globally?
No, in the U.S. That's mostly shale permits. So 40% decline in drill permits, and so we're seeing this very, very rapid reaction to prices. I just translate that in 1 or 2 years from now, we start to feel the first bites of that in terms of supply that isn't there. So trust me, no matter how bad the world economy is or isn't, we're always going to be using oil. And you know that. You go anywhere, go to any city, anywhere in the world, and tell me how many cars are on the road, and it's a traffic jam constantly. What's it?
Or Chris, or whether it's small cars or scooters or electric bikes. I have friends who went to China 15, 20 years ago. There wasn't almost any cars on the road. There was very little public transportation. There were bicycles everywhere. And now for a lot of Asia and many other developing world major cities, that's changed. People have motorcycles. People have small cars. There's public transportation using fossil fuels. So I think you're exactly right. Now, the BP Statistical Review came out, and it said earlier this year that global demand was still rising faster than global supply. And, the demand increases, what we hear from the oil bears was that, yes, demand was falling in the U.S., yes, demand was falling out of Europe and things like that, but it was more than being offset from demand increases in China and India, Asia, Middle East, Africa, South America, et cetera, in the developing world. Those people, they don't have, access to the cheap credit that we do in the U.S., but a lot of them have wanted to drive for most of their lives. They've saved up for either on their own or through their families, and they bought the first family car. And once they buy that first family car, whether it's, a small little Tata Motor car or something like, or a Chery in China or something like that, they want to drive. They don't want to stop driving. So regardless of what the oil price up or down is fluctuating here, they're not as price sensitive once they buy that first car. That's my opinion in the long term, at least. It's
absolutely true. They're not as price sensitive because, the guy with a motor scooter that gets 120 miles per gallon or more, who's bringing, the 8 ducks to market, his marginal utility for oil is so high that the average soccer mom with her, Suburban can't quite understand it. So it's entirely within the realm of possible. The changing of the guard for me was in 2007 or 8, depending on whose numbers you believe. And that's when the rest of the world overtook the OECD countries in terms of oil consumption. So that's mainly India and China and whatnot. But that was the changing of the guard. And since that point in time, if you want to understand demand, you understand the rest of the world, not the developed nations. And so that story is still, I think, sinking into people's consciousness over here in the West, but that's the case. And so those people who are driving around their small first family vehicle, their small scooters, things like that, they get a very high marginal utility out of that, meaning they're willing to pay a lot more for their oil than we are over here. And so, yeah, I'm expecting it's just numbers, Jason. At this point, we're looking at the scariest number I know is 3 billion, and that's the number of people who are expected to be in the middle class by the year 2025, up from 1 billion just a year or two ago. All those extra 2 billion entrants, they all want to have the same lives we do, even if they're only going to sip a tiny amount of gas. That's an extraordinary amount of demand that's going to be coming forward. So, this whole idea of oil demand hitting a peak is just a ridiculous notion to me because I travel and everywhere I go I put on my little energy glasses and I just see people burning oil as fast as they can 24 hours a day, 365 days a year, and that's just the nature of it.
Exactly, and look at car sales in China, right, and the rest of the developing world. I mean, that's where the majority of growth in the car sales market is, besides, these subprime auto loans where in the United States, these cars are going to be repossessed probably in the next 12 months. So I mean, like, those people, they're not getting the easy credit in China or something like that in order to buy a car there. To my knowledge, from what I've heard from my contacts who live in China, you have to save up, and you can't really get an auto loan. If you're a middle-class Chinese consumer, you have to save up and buy most of the stuff with cash.
Oh, great. So you have to wait until you can buy it instead of on credit. That just means that your demand doesn't get pulled forward. But ultimately, whether you buy it on credit or buy it with cash, you still end up buying the car through the efforts of your labor. It's just a little time lag if you're going to do it through cash, which is fine. So China's had all the time it needs. People have saved up. They're buying cars like crazy, and they're all going to need petroleum products in them, and that's just the nature of it.
Well, Chris, now in the remaining part of the interview, I want to talk about the precious metals market here. You've covered the precious metals market for a very long time. I found your crash course in 2007. It definitely helped wake me up when I was a stockbroker. We weren't allowed to discuss things like the crash course and inflation and Austrian school economics and precious metals when I was working at a large firm. So what's your opinion on precious metals here? Do you think we're close to a bottom, or do you think if the price goes much lower, that most of these miners are going to go bankrupt and we're going to start having supply shortages for silver first and then maybe later for gold for larger orders?
Well, my view of the precious metals markets is that they are just completely being run by the paper guys and gals, and that they are fully in the hands of speculators at this point in time. I don't think any particular supply and demand fundamentals are really applying here. And I've been getting a lot of chatter coming to me out of people who are in the refining business about the quality of the gold that's being shipped, out of warehouses here in the U.S. and through the London OTC market into the refineries. And it's basically bottom of the barrel stuff. They're finding bars with serial numbers that date them back to the 50s and 60s on them, old dusty relics, things with a variable quality that have to be refined pretty hard to get them back into the 3.9 or 4.9 quality kilo bars that are going out to the east. So my view on gold is that there's a vast hemorrhage going on from west to east, and that sooner or later the West either has to say, you know what, we really don't care at all about gold, forget about it, or they have to find a way to stem that flow. The honest way to stem the flow is with a price increase. The dishonest way is to, claim that gold is being used by ISIS or something. We have to make it illegal. But silver is another matter for me, and silver is the thing I am most bullish on. First of all, right now it's below the all-in cost of production for pure silver miners. Now, I know they're only 25% of the market, but
way below.
Way below. And so those miners are in trouble. I was in Peru a month ago, and I was talking with Rocco Benavides, who's the CEO of Buenaventura Mines, and he said that their all-in cost is about $17.50 or so, and here we are, $1 below that. So they have to decide at some point, are they going to continue to mine and lose $1 for every ounce, or are they going to, curtail their mining operations, or what are they going to do? That's a decision everybody's got to make in that business. So I love buying commodities, particularly ones that are used and literally consumed at the molecular level and lost, like silver. I love buying commodities below their all-in cost of production, which puts me firmly in the camp of thinking that oil's a great buy here as well. So not that they can't go lower from here, but either you believe we're never going to use silver again and we're going to stop burning oil, or you say eventually there's a recovery coming. It's always been my experience that a great time to get in and buy things is when you're below the cost of production.
Yeah, I agree. I like gold, silver, and oil a lot too. I actually thought Caesar was a good buy a couple weeks ago. I did a video about it. I was a little early on my timing, but my long-term fundamental analysis was, you know what? Well, we're going to need this deep water offshore oil again at some point in the next couple of years, because that's where the majority of long-term oil production growth is going to come from. Because those fields, unlike the shale oil fields, you're spending more money up front on the deep water, but you might hit a huge gusher, a 50,000 barrel per day field or larger in many instances. I mean, even the BP Macondo field, right, with the blowout and the accident and all that stuff, that was over a 50,000 barrel per day well. That was an enormous gusher, and Spindletop was over 100,000 barrels per day, so it was a very impressive well that they can still find deep water offshore. Yes, you're spending a lot of money to do it, but you're getting a well that can last many, many years at a really high production and flow rate.
Oh, absolutely. And when we look into what's really happened with the shale plays across the world, there was all this hope that what was in the United States could just be repeated everywhere, because there's shale basins all over the place. They're in Europe, Eastern Europe, they're in China, Australia, South America. And the truth is that, what they found was looking into and tapping the first wells. Poland was supposed to be this massive, massive shale gas play, just great geology, good shale. They get in there, they drill a whole bunch of wells. Everybody pulled out who was in there because the geology was just wrong. China's having trouble with their geology. They had the same thing in Romania, same thing in India. They're just discovering that not all shale plays are created equal, and it might be once again the United States was blessed with really nice geology that helped all this along. And not that there won't be other great shale plays in the world, but the idea that we'll just sort of shift away from conventional and deep water and we'll just start opening up shale plays all over the world is I think it is being a little bit too optimistic given what we've learned so far.
Yeah, I agree, and you definitely provide in the crash course video on your shale oil chapter, which I think our listeners should definitely take a look at. Well, they should look at the whole crash course, but I think the shale oil one's one of the best ones you've put out so far. You spent a lot of time talking about it. Is that the U.S. has other advantages too. Besides just the geology you talked about, there's all the infrastructure companies and oil service companies that are here. It's easier. There was a lot of water for the U.S. Companies to truck in and move a lot easier than, say, in China, which has, a large amount of distances to move the water, and there's not as many oil service companies. So there's a lot of other challenges for the shale oil plays in other countries that the U.S. Shale oil plays did not have to worry about. The U.S. had drilled. They had tried for over 100 years to try to tap the shale oils, so there was the core samples for all these areas. They knew where most of the good plays would be, and they just went back to the geological data. Most of those other plays, whether it's China or Argentina or Poland, like you mentioned, those plays have not been drilled that much. There have not been hundreds of core samples in those. So that's a lot of upfront CapEx. There was not the infrastructure around. It's not as easy to get the water to the plays, and as you know, as something you talked about, shale, it does use a lot of water. And in order to get and fracking sand to get the shale oil out.
Yeah, absolutely. Art Berman put it best. He said, the way we discovered these shale plays and the sweet spots is by braille. You just start poking holes, and the United States has about, I think, 5 million holes poked in it at this point, maybe more. A lot of wells. So we had a lot of data to go on. Some of these countries, it's just starting fresh, right? You just don't know anything until you put a hole in the ground and take some core samples, do some geology, do some testing, figure stuff out. And so that's really something that has to be appreciated here, is that to get those 5 million holes so that we had that braille map that we could start working from, plus the infrastructure, plus the expertise, it's very, very expensive in terms of time and cost. And so those things could be replicated in other parts, but the question is, who's going to put all that money up? And that's still not clear. So even as we're sort of trying to wrestle with, all right, how are we going to get the infrastructure? Who's going to pay for all this? How are we going to start poking holes in all these other continents to find these shale plays? We'll be resolving all of that. Meanwhile, we have a backdrop of, depending on whose numbers you believe, of global current oil from conventional fields declining by 3, 4, 5, maybe 6% a year, depending on whose numbers you believe. That inexorable 3 to 6% decline that's happening is production that has to be replaced by other means. We don't know of anything that really works except stuff that's just very expensive. And by the way, most of it doesn't play at the current price of oil that I'm looking at.
Exactly, and that 3% decline rate goes back to your video in compounding. So that 3% decline rate means what, in 24 years, that the production of that oil well is going to be cut in half. So even if it's Ghawar, which is, the big heavy lifter of all the world's oil fields in Saudi Arabia, if that's declining at 3% per year, and from what I've heard, it's probably declining at double that now at this point. But if it's declining at 3% in 24 years, the amount of production out of that well may be cut in half. So it's just something that most, the long term, the markets, like you said earlier in the interview, in the short, the markets aren't really thinking long term about something like this, but it's something that people should start thinking about.
Oh, absolutely. And I know the military is thinking about it, but the civilian branch of the U.S. government seems to be just absolutely blissfully unaware or bought into the Wall Street hype or whatever. When I hear President Obama say we've got 100 years of gas, which is just ridiculous, absolutely a ridiculous number that there's no particular sets of numbers out there using proved and probable reserves that gets you anywhere close to that, and not if you include the idea that we're going to increase our consumption of that, which we are. Dow's building plants. We've got gas to liquid plants on the books. We've got LNG terminals being talked about, compressed natural gas for transportation. Lots of uses are being discovered for cheap natural gas. So once you include the idea, which is not tricky, that we're going to increase consumption of it, the amounts that we have just shrink vastly in terms of how long they're going to last. So we still have, I think, fantasy energy policies operating at the national level in the U.S. and I think across the world to some extent. But
yeah, I agree. There's been an effort here to postpone reality, to not think about the long term. Wall Street, politicians, bureaucrats, special interests, even the large corporations who are doing the stock buybacks, and they're not growing the top line with revenue. they're not thinking long term. It's all short term, myopic, rent seeking type of behavior in order to either just beat earnings for the next quarter and trigger the stock options bonuses, and there's an incentive problem there. There's an incentive problem throughout society, whether it's corporations or politicians or bankers or anything else. And I just wish the society would get away from this short term thing, and we would get back to looking at long term problems so we can make smarter long term investments here that would be good for the economy, for the environment, that would be more win-win scenarios more than, win-lose, which I think is a lot of these rent-seeking behavior and myopic things, because, it views kind of the economy as this pie. The pie's not really growing at this point. I don't know what your views are of the whole economy, but I don't think any economy at this point on the entire planet is growing at this point. I think they're all contracting, and I think all these groups, special interest groups and politicians, etc., are just all fighting over larger and larger slices of a shrinking pie instead of, like I said, thinking long-term where how do we grow this pie so there's enough slices of pizza for everyone to get a good slice. That's just not happening at this point.
No, that's very well said, and that's my analysis, which is that once oil gets to be a limiting factor in this story, you're going to find that your economic pie just doesn't grow, not like it used to. Of course, you could do it differently. We could do it smarter. We could do a variety of things, but the extent to which we try and preserve the status quo, right? So what's the status quo? Get people to borrow money so that they can buy stuff that they can't currently afford. We want them to buy more cars, more houses. We want them to go to Black Friday and buy more TVs at whatever prices they can get them for, maybe wrestle each other. We want that whole consumer behavior to continue. That's the old model. Now, there's a new model we could get out in front of us, but I think the pillar of that new model is to say, oh my gosh, look at this. We are not going to be able to grow energy on a net basis per capita. I know I threw a bunch of terms in there, but that's really been the engine of our growth in the past, was having net energy per capita increase. And now it's stagnant at best. And I think it goes into decline in either starting now or very soon. And that's just a game-changing sort of a piece. But our leaders are saying, no, we don't want to even consider that. That way of life is not negotiable in America, or whatever our little fantasy is. And so we're not looking at those long-term deals, so we're not making the long-term investments we need to make. And those would be great opportunities for us, and people would feel good about them, and they'd create great jobs. But instead we're pouring all of our wealth into the old model, which frankly is gunboat diplomacy and making sure Wall Street never suffers any particular losses and maintaining a very strict economic hierarchy in this country, because that's how we do things. And that's fine, but the tensions build when the pie is no longer expanding, because the nature of compounding, this is not a social statement, the nature of compounding is once you have more money than you can spend, it will grow furiously for you, because that's the nature of compounding, and that's what we're seeing. This wealth inequality is just massive and growing. Simply, it's a feature of the system, but when the wealth inequality is growing massively due to compounding, at the same time the pie isn't growing, it simply means that the top is taking ever larger shares of that pie at increasingly faster rates. That's the world we're in. And oh, by the way, it was all the way back to Plutarch who said that the oldest and most fatal ailment of all republics is a gap between the rich and the poor. That's where we're heading, and nobody's really talking about it, but we can all feel it. You can tell that things aren't right. And I think that this is all completely understandable once you put the energy glasses on and you understand where we are in this energy story. It ain't cheap. We can't grow it like we used to. That's a new world.
Yeah, Chris, I think the debt-based fiat currency, the unbacked fiat currency, these banknote scheme, the Federal Reserve and other global central banks using these types of inflation and credit growth and explosion is an exponential function, like you mentioned in the crash course. I think it was all built on the fact that there was cheap energy in abundance, and they could do that because there was cheap energy and because the underlying economy for a while was benefiting so heavily in new products and services based off petroleum products and things like that. So it all started with energy. I think energy was probably at the base of that pyramid to start off with. Exeter's inverse expansion pyramid. You could arguably put oil at the bottom there that built all the other things out. I want to thank you again for your time. We're a little bit longer than the time you gave me. Please tell listeners more about the crash course, where they can go watch the new crash course you just put out, and more about the Peak Prosperity website.
Sure, I'd love to. The crash course is a video series that's now 28 chapters in length. It's all just recently been updated, and we're releasing the new chapters every week on Friday, and I guess we're up to chapter 20-something at this point, so we're almost there. And it explains what's going on in the economy and with energy and with the environment. It puts it all together. Says we have to understand all three at once. So it's just completely just some data and some good information people should have. And it's been translated into a bunch of languages. So it's actually fairly popular in the world right now. And all of that's housed at peakprosperity.com, where we have both, I think about 90% of our information is freely open to the public, and we have a subscription service for people who want to be kept a little bit more closely informed about where we are in this story. So we analyze all kinds of things there for people, and it's mostly just centered around this idea. It's time for us to become resilient. Better not hope that the government's going to fix anything. They probably won't. So
probably make it worse.
Probably make it worse. By not letting this crash in 2008, I think the Fed has just put us 4 more steps up the step ladder, and we're going to have a bigger fall than we could have had if we'd faced up to reality. So that's our framework. It's just this is unsustainable. Anything that's unsustainable is going to stop. We believe we should stop on our own terms if we can. So that's what we explore at the individual level, because guess what? We're not going to figure it out at the collective level.
Yeah, I agree. Well, thank you, Chris, for your time. I definitely enjoy the crash course. I've been trying to keep up with the new videos you put out. Did find your work in 2007. It was one of the first pieces of work that woke me up and really started getting me questioning about what was going on with Wall Street and oil and things like that. And we saw the oil price spike, and then shortly after I saw the crash course, the bank started collapsing. So thank you again for your time, Chris, and hopefully we can have you back on in the near future.
Fantastic. I'd love that.